Next month, cannabis may be legal on a federal level in the United States. It is currently illegal on a federal level, but on a state level, it is legal in certain states. Let's look at 4 U.S. cannabis stocks a little closer to figure out whether they're a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing 4 U.S. cannabis stocks by analyzing their financial ratios and dissecting their financial statements, so we can determine whether they're a buy or a sell. The 4 stocks we're going to look at trade in the pink sheets. They don't trade on a major exchange. Most of the stocks on the pink sheets are penny stocks, and they don't meet the qualifications on trading on the NASDAQ or New York Stock Exchange. But these 4 companies do meet the qualifications to trade on a major stock exchange, but they're barred because their products are illegal on a federal level. Let's get started with the model. The first company is Cresco Labs. It's located in Chicago, Illinois, and it's a small cap company, 1.7 billion market cap. It's trading at $8.44 a share, and it has 164 million shares outstanding. Let's look at their financials. And the way you value a company is you estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has negative free cash flow every year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They also have negative net income every year. Revenue is a sales for the company, and it goes from 43 million and triples to 129 million, then doubles to 238 million. So they are growing at a pretty rapid pace. This is the company's income statement. The top is the revenue. Below that is cost of revenue. These are the expenses that are directly tied to making the company's products. Below that is gross profit, which is a difference between revenue and cost of revenue. And then below that is operating expenses, which are the expenses that are not directly tied to making the company's products. And that's more than the gross profit because they're a young company, so they have to invest a lot into their business to grow it. And they have negative operating income of $30 million. They also have $23 million of interest they pay in their debt, so that's why they're reporting negative net income. But as sales increase, the company should become more efficient and more profitable. This is the statement of cash flows. The operating cash flows in the trailing 12 months was negative $63 million, and they spent $121 million in capital expenditures. CapEx are investments in property, plant, and equipment. So their free cash flow in the trailing 12 months was negative $183 million. Let's look at a capital structure. They have $95 million of debt, $187 million of equity, and the weighted average cost of capital, which is a blend of the cost of debt and cost of equity, is 12.5%. And that's the discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $3.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.3 billion. We divide that by 164 million shares. And we get a calculated stock price of $14.04. They're trading at $8.44, so they're trading at a 40% discount. It's a strong buy according to the model. Simply Wall Street is higher than me. Their valuation is $16.71. So it's really hard to value these 4 stocks we're going to look at because they have negative free cash flow. So I had to look at analyst estimates. I also looked at the financials of other cannabis stocks to try to get an idea of how to value these companies. So you can see the stock has been pretty steady since it IPO'd. It did dip a bit and came back up. I expect this stock and other cannabis stocks to go way higher if the US approves cannabis on a federal level. If you invested $10,000 into this company when it IPO'd last year, you'd have a little more than $10,000 today. Let's look at their financial ratios. The average PE in the market is 15.8. The median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have a negative PE because they have negative net income, so we can't look at this ratio. The average price of sales is 5.0. The median is 2.1. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 5.8, so they're a little worse than the average. The average price to book is 4.6, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 7.4, so they're much worse than the average and median. The average interest coverage ratio is 12.4, the median is 3.9. Interest coverage ratio is EBIT over interest expense. They have negative EBIT, so they have a negative interest coverage ratio. EBIT is earnings before interest and taxes, also called operating income on the income statement. The average ROE is 12%, the median is 12%. ROE is net income over equity. They have a negative net income, so they have negative ROE. Equity is total assets minus total liabilities on a balance sheet. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities, so they can cover their current liabilities. They're at 1.1. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. The next company we're going to look at is Curaleaf. This is located in Wakefield, Massachusetts. It's a mid-cap company. Market cap is $5.5 billion. They're trading at $10.68 a share, and they have 440 million shares outstanding. And they also have negative free cash flow and negative net income every year. But their revenue has gone up tremendously from 19 million to 351 million. This is their income statement. The revenue's on top, so the gross profit looks pretty good. It's just their operating expenses are so high. They did have positive operating income in the trailing 12 months. That's the first time they had positive operating income. But they had to pay $29 million of interest on their debt, so it brought down their net income to negative. This is the statement of cash flows, so you can see they have positive operating cash flow in the trailing 12 months. The way you calculate operating cash flow, it starts with net income, and then you add back the non-cash items from the income statement. You also adjust for changes in working capital. And operating cash flow is a better indicator of a company's financial health than net income. And the way you calculate free cash flow, it's operating cash flow minus capital expenditures. So they did have negative free cash flow every year. But they are young companies, so they need to invest a lot in their business to grow it. But the idea is that the investment in CapEx will grow the company and provide them positive free cash flow in the future. Let's look at a capital structure. $198 million of debt, $409 million of equity, and the weighted average cost of capital is 11.5%. And we estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $9.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $6.6 billion. We divide that by 440 million shares. And we get a calculated stock price of $15. They're trading at $10.68, so they're trading at a 29% discount. It's a buy according to the model. Once again, Simply Wall Street is higher. They're at 2034. Simply Wall Street gets its value from the average analyst estimate. The stock price has been up and down since its IPO. If you invested $10,000 when this company IPO'd, you'd have $18,000 today. That's an 82% return on investment. Let's look at the financial ratios. They have a negative PE, so we can't look at that. They have a high price to sales ratio of 13.4 and a high price to book of 11.5. Their interest coverage ratio is negative since they have negative EBIT. They have a negative return on equity, and they have a good current ratio. They can easily cover their current liabilities. The third company we're going to look at is Green Thumb Industries, and they're a mid-cap company. Market cap $4.2 billion. They're trading at $20.34 a share, and they have 159 million shares outstanding. This stock has negative free cash flow and negative net income each year, but their revenue has grown quite a bit every year. This is their income statement, and their revenue in the trailing 12 months was $366 million, cost of revenue $176 million. So they did have a gross profit of $189 million, which is much bigger than in prior years. Their operating expenses are pretty high, but they still had positive operating income, which is good. But their operating income almost equaled the interest they paid on their debt. So they had negative net income that year of $45 million. This is the statement of cash flows. So even though they had negative net income, they operated with a $47 million profit because the income statement includes lots of non-cash items like depreciation, and that has to be backed out when you calculate operating cash flow. They did have $85 million in CapEx that year, so they had negative free cash flow like they did in every other year. Let's look at the capital structure. $156 million of debt, $841 million of equity. Their weighted average cost of capital is 16.73%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for. That's $15.8 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $9 billion. We divide that by 159 million shares. We get a calculated stock price of $57. They're trading at $20, so they're trading at a 64% discount. It's a really strong buy according to the model. Simply Wall Street is much higher. They're at $80 a share, so they're saying the stock is really undervalued. So apparently Simply Wall Street expects their future cash flows to be much higher than my model indicates. So it looks like the stock jumped way up when it IPO'd the first month, but it's come back down. The stock has been climbing a lot the past 6 to 12 months. The stock is almost at its all-time high. If you invested $10,000 into this company when it IPO'd in 2018, you'd have $27,000 today, 175% return on investment. Let's look at their financial ratios. Negative PE, so we can't look at that. They have a pretty high price to sales of 8.8. They have a good price to book of 3.8. They have a negative interest coverage ratio because they have negative EBIT. Negative ROE because they have negative net income. They have a decent current ratio. They can almost cover their current liabilities with their current assets. The last company we're going to look at is Trulieve. This is a mid-cap company, 2.9 billion market cap. They're trading at $26.49 a share, and they have 39 million shares outstanding. They have negative free cash flow in 2018 and 2019, but they did have positive free cash flow in the trailing 12 months. Their net income looks good. It's positive every year. Their revenue is growing. It more than triples from 2018 to 2020. This is the income statement. Their trailing 12-month revenue was $367 million. Cost of revenue was only $11 million, so they had a pretty high gross profit. Operating expenses weren't too bad relative to their gross profit, so they had a lot of operating income each year. So this company reports positive net income each year, which is quite a bit different than the other companies we looked at. The company reports healthy operating income each year, $81 million in trailing 12 months. Their capex was $68 million, so they have positive free cash flow in the trailing 12 months of $13 million. They did have negative free cash flow in 2019 and 2018, but this company seems to be doing much better financially than the other companies we looked at. Let's look at a capital structure. $204 million of debt, $282 million of equity. Their weighted average cost of capital is 10.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for. That's $2.5 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.4 billion. We divide that by 39 million shares, and we get a calculated stock price of $61. They're trading at $26.49, so they're trading at a 57% discount. It's a really strong buy according to the model. Once again, Simply Wall Street is higher than me. They're at $75 a share, so they're saying the stock is even more undervalued. This stock has done really well since it's IPO'd. It only seems to be rising year after year. If you invested $10,000 into this company when it IPO'd last year, you'd have $32,000 today. That's a 220% return. Let's look at their financial ratios. They have a great PE of 8.2. They have a good price to sales of 2.8 and a good price to book of 3.7. Their interest coverage ratio is great at 22.3. They have a really good ROE at 45%, and they have tons of current assets, so they can easily cover their current liabilities. The best way to look at ratios to compare them to similar companies, I've done videos on Aurora Cannabis, Canopy Growth, Pacira, Sundial, Supernus, Teva, and Tilray, all in the same industry as Cresco, Curaleaf, Green Thumb, and Trulieve. And if these companies have a number in green, they're better than the average. If they have a number in red, they're worse than the average. Trulieve has the best price to earnings ratio of all the companies on this list. Most companies are negative PE. Only Trulieve and Supernus have positive PE, which means they have positive earnings. The rest have negative earnings. Price to sales, Trulieve is better than average. So is Cresco. In terms of price to book, Trulieve and Green Thumb are better than average. Current ratio, Trulieve has the highest current ratio of all the companies. So this is Trulieve's current assets. They have $91 million of cash, $271 million of inventory. So they are sitting on a lot of inventory. So hopefully they can get rid of that inventory and turn it into profits. Trulieve has the highest ROE of all the companies at 45%. Most of the companies have a negative ROE. In terms of debt, Green Thumb has the lowest amount of debt of all the companies. And in terms of market cap, Curaleaf is the largest of the 4 companies we looked at, then Green Thumb, then Trulieve, then Cresco. And nobody in this industry pays a dividend. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get your own custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.